Thank you everyone for joining us today. Happy to have you joining us as we talk about mission-aligned portfolios. We are joined today with Stephen Fraley from Invest, who is going to lead our discussion today and providing some real-world examples of what this looks like as you implement this into your own nonprofits and in the nonprofit space. So by way of introduction, my name is Pam Eggert, and I am a partner here at Eide Bailey in the Phoenix office and lead up the nonprofit practice here. For those of you that don't know Eide Bailey, we are a top 25 CPA firm that serves the nonprofit industry. We do your typical audit and tax compliance work, but in addition to that, we do a number of other things in the consulting space. We can help on technology side of things, cybersecurity, data analytics. It goes a wide array of services that we can provide. But today we wanted to partner with Invest. They're experts in this field. They serve the nonprofit industry as well. So we aligned with them. And with that, I will pass it over to Stephen. And as Amy mentioned, if there are questions throughout the presentation, feel free to put those in the Q&A. And I will go ahead and monitor those and bring them in when it sees fit. So with that, Stephen, I will let you take it away.
Great. Good morning, everybody. Thank you, Pam. Thank you, Amy. Appreciate the introduction. And I'll also say for Amy's sake, if I have technical difficulties, I'll also be relying on you as well. So those of you joining us this morning will not be the only ones leaning on Amy for any technical difficulties that we may have in this continued, Zoom and webinar world that we're living in. But just as a quick introduction, I know Pam spent a little bit of time. Invest Portfolio Solutions, we are a fee-only independent investment consultant and RIA. We, again, have quite a bit of expertise on the nonprofit side, specifically building mission-aligned portfolios that help further your mission as a nonprofit and put those dollars to a little bit of extra work, if you will. We serve as co-fiduciaries alongside all of our clients. And again, are very mission driven. So we think we have a lot of strong alignment with the nonprofits that we serve and ultimately are stewards to their financial well-being. So as Pam, laid out here, real quick, just to make sure everybody's awake, I wanted to start with a funny video. If anyone's ever watched the movie or the show Billions on Showtime, pretty great show, but go fill up your coffee, make sure you're wide awake for the next 45 or 50 minutes. I've got mine right here ready to go, as always, and look forward to any questions that anybody has. But as I was saying, Pam mentioned earlier, nonprofits, of course, play a very critical role in the overall health and well-being of their community. So thank you, first and foremost, for your work. Thank you for spending some time here today. We work with and talk with, as mentioned, a number of different organizations, spanning all sorts of different impact within their communities, both locally and nationally. And really nonprofits are really interested in learning more about how their investment portfolio can have a greater impact in furthering their mission. So, but where do we start, right? There's a lot of complications. There's a lot of things to consider. Today, that's what we're going to talk about. I'm going to discuss some of the key factors and best practices that your organization should consider if interested in exploring socially responsible or mission-aligned portfolios, and really going to walk through these three key kind of components that you see here. So the nuances of mission-aligned portfolios, of course, executing that with high quality due diligence, and of course, from a monitoring standpoint, how as fiduciaries do we go about making the best decisions. As you've probably all experienced in one way or another, more and more organizations and key stakeholders within those organizations are focusing and interested more on community and environmentally and socially aware investing, or the impact that they may have based on some of their practices. A recent survey actually by PricewaterhouseCoopers indicated that 83% of consumers believe that companies should follow some sort of ESG best practices. On top of that, 91% of business leaders and their executives believe that they personally or as an organization have a responsibility to act on these ESG issues. And about 85% plus of employees really want to work for organizations or companies that really care about the same things that they do. So this is becoming a bigger and bigger piece of the conversation. And again, of course, that's why we want you guys to hear this and want to hear any questions that you have about possibly furthering your mission. So we're going to start here with a polling question just to kind of kick things off, make sure everybody's still with us after that coffee break. Has your organization met with any third-party stakeholders regarding responsible investing considerations? Yes, no, or unsure. So again, this could be donors, students, if it's a college or university, employees, other community leaders, et cetera. So has your organization met with any third-party stakeholders regarding responsible investing considerations? Again, yes, no, or unsure. So just give everybody another few seconds here to get their answers in and see kind of where the group sits with us here this morning. It looks like results are pretty evenly split. Yes, no, and unsure. And the reason I bring this up is this is really where we see organizations beginning these conversations, right? They're typically getting some sort of external maybe pressure from organizations, from donors, asking questions about, are our assets being invested environmentally friendly? Is there any socially responsible factors being considered with the investment of, say, the foundation dollars or the endowment? And it's happening locally everywhere. It's happening, we're based in Denver, but we have office in Arizona. It's happening with Denver University here, but actually in the state of Arizona specifically, there's been quite a bit of pressure from student-led organizations, both at the University of Arizona and Arizona State University campuses, really pushing for a divestment of fossil fuels. That's been really a kind of hot topic from a divestment standpoint. We've seen a lot of student-led organizations put a lot of pressure on the universities to fully divest or essentially liquidate and get out of any investments in that organization's endowment that are related to fossil fuels. And so actually, the University of Arizona has essentially agreed to try to divest all $65 million of fossil fuel related investments out of the endowment by 2025. So again, a kind of a real life example of what we're seeing on the ground. And so as a quick kind of starting point, I just wanted to lay out what are we talking about here. So you've probably heard some of these buzzwords at some point over the course of the last year or two or a few years, but what are ESG, so environmental, social, and governance, SRI, or socially responsible investing, and impact investing? So starting at the top, ESG is really the concept that environmental, social, and governance issues can have a positive long-term impact on the financial success of an organization. So really, the thought is that you should incorporate those metrics into just your regular general financial analysis. Socially responsible investing is kind of taking this a little bit further, and instead of just incorporating, you're generally doing a positive or negative screen of certain securities, companies, industries that go against maybe your organization's mission. So some examples here: alcohol, tobacco, fossil fuels I mentioned. And so what you're doing is you're either positively screening, saying, hey, we want to have exposure to investments that are environmentally friendly. So maybe you add additional exposure to those types of investments in the portfolio, or more commonly a negative screen, like the fossil fuels, basically saying we want to screen out any companies that are generating fossil fuels or negative environmental impact. So we will not invest in them. We will screen them out of our investment process. And then lastly, kind of taking things again kind of to the next level would be the thought of impact investing, but really an investment strategy that has a specific societal or environmental benefit or impact, in addition to, of course, financial gains. But again, really focusing on how can we put those dollars to work and have a specific impact that's maybe near and dear to our specific organization or nonprofit. So where do we want to kick things off here? And I think that the first thing to really consider from an organization standpoint is, what would be the investment policy considerations of incorporating socially responsible or environmentally friendly investing into the current process. So first and foremost, I think, Innovest likes to work with our clients to educate committee members and other key stakeholders to really get alignment around, what are the most important issues, what are the types of investments you may not want to own within the portfolio. And the reason why we really think this is such an important kind of fundamental step in driving a sound long-term process is because, as you all are aware, there's board turnover, there's kind of change in regime, meaning, maybe there's some strong vocal leaders within an organization that turn over. And maybe, what you don't want to, or what you want to avoid is really having a couple of key personnel drive some of these investment decisions. And then once they leave, that kind of says, what, hey, this isn't really that important to our organization. So why are we doing things? So to really sustain that investment program, that mission aligned portfolio long-term, we think it really has to be important to the organization and the key beneficiaries. We talk about establishing revenue thresholds that may be important to your organization. And so for examples to walk through, and what we mean here is some organizations look at this differently than others. Some say, for example, we don't want to own anything that has to do with fossil fuels. We're just going to have a zero revenue threshold. If there's any revenue derived, it's out of the portfolio. Some organizations, depending on what's important to them, may have a 5 or 10 or 15% revenue threshold, saying as long as it's not a key aspect of their business and it's not the primary revenue stream, we're okay with having some ancillary exposure to that particular industry or sector. But you can see some of the examples we've laid out here. I mentioned, tobacco here because I want to provide an example that I think is pretty interesting. So about 20 years ago, CalPERS, which is the California Public Employees Retirement System, the largest public pension plan in the country, decided to fully divest out of their tobacco securities. They did this actually starting in 2001. Their investment consultant since then did a calculation to see, how much has that benefited or hurt the portfolio over that time, and came back and really said, at the end of the day, this actually cost the pension plan about $3.5 billion and lost financial gains by not having exposure to tobacco companies over that 20-year period. So is that okay? Again, having conviction to stay with that, even if it goes against the long-term returns of the portfolio or of the endowment or of the foundation. Another thing to consider is the portfolio allocation and diversification. So, similar to tobacco, a common negative screen is energy and anything energy related. Energy, though, is historically made up a significant portion of the kind of investable universe. And so I wanted to show this kind of sand chart here that shows various allocations to different industries, which you can see on the far right-hand side within the S&P 500 over time, going back to 1990. Energy is that kind of light blue portion at the very bottom of the page. And you can see, based on when we were talking about from a historical standpoint, had significant deviations in how big of an impact it had on the overall return of the S&P 500. So for example, going back to 2008, energy made up about 15% of the entire index. So maybe not having exposure to the entire sector would make the investment portfolio look significantly different than the general market, if you will. So how that ebbs and flows over time, again, will ultimately probably dictate underperformance or outperformance of your mission-aligned investment program. So alternatively, we mentioned tobacco, both Altria and Philip Morris are both kind of top 5 or top 10 holdings within consumer staples, which is that lighter blue area kind of in the middle of the page. So again, it does affect overall asset allocation, and those are just considerations that groups and committees should think about when exploring developing a custom investment portfolio. And so I'm going to pause here for another polling question. So I'm going to read this one out, give everyone a little bit of time, but would ownership of certain companies or industries be in direct conflict with the central mission and public profile of your organization? Similar answer options, yes, no, or unsure. I'll read that one more time though. Would ownership of certain companies or industries be in direct conflict with the central mission and public profile of your organization? Great. So it looks like, about half of the responses said that, there could be certainly companies or industries that would be in direct conflict with the central mission and public profile of your organization. So I think that's really kind of an important part or important place to start, is really kind of answering that question. We work with clients that based on their organization, based on their mission, would agree, right? So we have a client whose primary objective and mission is to reduce and eliminate cancer. So specifically, tobacco companies, there's a zero revenue threshold there. I mean, they just, there's nothing to say about it. They will not own any companies that derive any sort of revenue from tobacco or tobacco related or cancer causing industry. So I think that's a great place to start and continue on with our conversation. One of the other nuances we see and things to consider is whether the investment strategy or fund that you would potentially consider is fully aligned with your mission. So many mission aligned portfolios or socially responsible portfolios are really only 95% aligned, but so are most traditional investment funds that aren't necessarily, branded or deemed ESG or SRI or socially responsible. So what is in that remaining 5%? What are some of the other things we can look at? It really goes beyond the investments. So, a couple of things to think about, when we're talking about, kind of going that extra mile is the company that we're investing in. So say we invest in an investment product, are they engaging with management of the underlying companies they own to help push forward, some of the initiatives, to engage management about best practices? That's something that we really look at when we talk about, are they going that extra 5% to be fully aligned with what our clients are looking for in an investment partner. Additionally, when we do delegate that responsibility, it's in their responsibility as an investment firm to vote our shareholder votes or proxy votes. And so we want to make sure they're voting those proxies in an acceptable manner that is aligned, again, with the organization's goals and objectives, and as it's outlined, of course, within the investment policy summary. So we want to see a demonstrated process that goes beyond just the due diligence in the investment process, but hey, what do they do above and beyond that? Do they engage with management? Do they vote shareholder proxies in alignment with our clients' expectations? Some other considerations, that we've seen, again, that we want to make sure that folks are aware of and consider is, how do you look at owning an individual security? Or how do you look at having exposure to a certain sector or industry? We've seen a lot of cases where advisors are excusing violations because they're owning something through a mutual fund or a pooled product. And so instead of actually owning the underlying investment itself or the underlying stock, they own shares in a pooled investment fund that happens to own the stock. So is that okay with your organization to financially reward those companies, but not to actually physically own the stock? In our opinion, it's not. And for most of our clients, they don't want to have that exposure, even if it's through shares of a mutual fund. But we do see, of course, with a lot of investment strategies, especially on the alternative side, that this may be the case. You're not going to fully be able to screen out those investments. In turn, you are still, again, providing financial capital to companies that you may not want to have association with or may not want to own within your portfolio. Another aspect, index funds. We see some of the large index funds providers out there promoting they are socially conscious. I think a couple of things here to factor in. Investment firms, for example, large index funds or firms can sign what we call the United Nations Principles of Responsible Investing Act, or can become a signatory, which really just says, as an organization, they're willing to push forward the thought of responsible investing. So ESG, SRI, DEI investing. Now, that doesn't mean that the underlying investment strategy that you may be invested in is, according to those socially responsible aspects. So I think that's one important thing to note there. And then I also mentioned earlier about some of the proxy voting and what that looks like. So I think that's another thing to consider when we look at investment funds. So we've seen plenty of examples where large index funds tout that they're socially conscious, they're socially responsible, but at the end of the day, they're voting proxies that go against, for example, board diversity or disclosure of board diversity. They're voting proxies that go against reporting on maybe a gender pay gap, or they're voting against proxies that would ultimately go towards a significant environmental resolution. So again, understanding specifically what those companies are doing, how they're truly being socially conscious, I think is really important as we walk through this process and really feel comfortable with what you as an organization owns or is investing in. The manager screening process, this is becoming very, very difficult, I think, and one of the reasons being that there's no general consensus in terms of what is ESG investing, what is SRI investing, what is DEI investing. There's no regulatory oversight, for example. So it's kind of up to the investment manager, the firm actually investing those assets to determine what that is. So it's very objective in nature. So that does cause a little bit of difficulty and some concerns when we go through the investment management due diligence process. So, we want to make sure that portfolios have been screened to ensure they're in line with your organization's missions and values as we've outlined and stated within the policy statement. So if we've specifically stated that we don't want to own these types of securities, we have a zero revenue threshold, we don't want to own these types of companies, we want to make sure that the managers are actually following that within their own screening process. So continuing to monitor that on an ongoing basis and making sure, again, doing a full audit of the fund holdings and making sure that those are fully aligned with the expectations as laid out in the policy statement. Another important kind of example I wanted to bring up on the screening process is we've seen some managers, in particularly in the private side or in the hedge fund universe, kind of simply just haircut returns, if you will. So essentially saying, we're just not going to attribute the performance, good or bad, to the industry that you don't want to own. So for example, going back to tobacco, if you're an investor, you want to invest in the strategy, this company is saying, we do offer a socially responsible portfolio. You don't want to own tobacco, great. You can invest here and we can take care of that for you. Well, the reality is your dollars are still going towards maybe the main portfolio that they're managing without any constraints, but your returns or the returns that they're providing are simply disallowing or not being allocated to those particular industries or sectors. So in our opinion, of course, that is not ethical. That's not what our clients are looking for. But again, going beyond and kind of doing some additional digging, you'll see that companies and investment managers have become very creative in how they're branding themselves as socially responsible or environmentally friendly. And the reality is a lot of money is going into the space. And so people want a little bit of a piece of the pie, if you will. So something certainly to consider. Going to do one more question here. Polling question number 3 out of 4 today. Has your organization implemented a responsible investing program to date? Yes, no, or no, but we are exploring it or we are considering it. Again, has your organization implemented a responsible investing program? Yes, no, or no, but we are considering it. Yeah, we'll be curious to see where the group lands here. We work with, again, a wide range of different nonprofit organizations, and some of them are just having those, conversations. Some of them have been implementing. Some of them want to continue to improve their implementation. So look forward to seeing what we see with the group this morning. Great. So about half said no, which I think is pretty consistent with what we see. Nice to see that about 30% has implemented some sort of a responsible investing program, and seeing some more that are considering it. I think this is an important question. It's interesting because, the way that an organization goes about implementing, a responsible or mission aligned investment program can look so differently depending on the organization. We have clients that want to have a range from a full foundation portfolio or endowment that's 100% mission aligned, so that every investment within the portfolio has been screened, has been vetted, and ultimately is aligned with their long-term mission. We have other clients that want to carve out a certain portion of the portfolio that's deemed as mission aligned. We actually have clients that have actually segregated it out and separated their socially responsible or mission aligned portfolio from their main portfolio. And maybe that has to do with specific donor requests. So they say, hey, we want to be a large donor. We want to provide significant long-term capital or financial resources to the organization. But if we're going to do that, we want to invest it this way. And so we've seen, again, a lot of nonprofits and organizations actually segregate out specific accounts that may have their own direct investment objective. So a lot of different ways to certainly go about implementing this type of a program. So before we move on, I just wanted to get that last question out of the way, so that if anybody does need a quick recharge or refill, they can feel confident that they can go do that without missing any more polling questions. So go get that refill, recharge the batteries a bit, and we'll get moving forward here. But if you haven't noticed, there's a little bit of a coffee theme going on here. I'm a big advocate and basically can't live without my 3 to 5 cups a day. So whether that's healthy or not, that's a different story, of course. So we've talked about some of the nuances to consider. Next, I want to move into some of the due diligence kind of issues that come up, or some of the things that we should consider. So first and foremost, when going through the diligence process and looking at managers that we believe have the ability to align with our clients, it's really about demonstrating a strong process over time. And so first and foremost, one of the biggest kind of headwinds or constraints that we have is that when we are focusing on customization, when we want to screen out certain investments, we want to have allocations to specific investments or industries, you're ultimately going to have a smaller universe of available investment managers and strategies. Some of the reasons being that some managers don't want constraints. They want to have a full open universe of investments they can choose from, because they don't want to have that as a potential headwind for performance. Some issues that we want to consider and that we've seen specifically when focusing on managers in the kind of ESG or SRI or socially responsible part of the market is that a lot of times we see an unproven team. I mentioned that this is a kind of a hot topic or hot area amongst organizations. And so one thing we've seen is that a lot of new strategies are popping up. A lot of folks that hadn't managed these types of strategies previously are now all of a sudden saying, hey, you know what, there's a lot of money flowing in, so I'm going to develop my own ESG strategy. So they haven't been doing it before. They may not be proven. That could cause some issues. Inconsistent philosophy, which is, again, kind of, it doesn't matter what you're looking at from an investment standpoint. We want to make sure that investment philosophy is tried and true and consistent over time. We see minimal assets a lot of times with some of these managers. Again, a lot of them being newer, a lot of them branching out to kind of start their own strategy. And so that is a concern, depending especially on the size of your organization, depending on the allocation you may make. We want to make sure that asset base is stable and that there's no issue with that organization going forward in terms of their ability to continue to operate and provide the best in class resources for our clients. There's also oftentimes shorter track record, which makes performance measurement, of course, a little bit more difficult. So, they could have had a 1 or 2 or 3 year track record and done really well. But if it's been a really strong market, or as I mentioned, some of the sectors that maybe an environmentally friendly strategy would allocate to outperform the market, yeah, their performance is going to look good. But what does that look like over time? That becomes a little bit more of an unknown. So, focusing on that track record, we think is really important. Similarly, there could be significant underperformance relative to major indices. So I mentioned that kind of sand chart earlier of the S&P 500. Again, depending on those sector-specific allocations, some of those larger individual names within a sector or within the index, if you have more exposure or less exposure to them, that's going to have a significant driver of long-term performance. And of course, lastly, a huge headwind long-term to performance, higher fees. Generally, we do see that with these types of custom strategies. There's going to be higher fees associated with it because there's additional monitoring, additional screening. And so that's something certainly to consider, and certainly could be a headwind long-term to performance, because ultimately the higher fees you're paying, that comes directly out of your organization's investment returns and portfolio. So, continuing on with the due diligence, we really do believe in providing and performing that high quality due diligence, not only from a quantitative standpoint, but from a qualitative nature as well. So not only do we want to understand performance and what's happening there, but we want to understand the people, who's managing the money, are there operations, institutional quality, would we feel comfortable advising our clients to invest within that organization? So we really need to understand the intricacies of the investments. That's particularly important on the private side, where private investments aren't quite as transparent. There's bigger unknowns. There may be more complex structures of those investments. So really understanding how those investments are set up and how we expect them to perform. We want to be really comfortable with the team. I mentioned that. With their investment process and philosophy, and of course their ability to execute, not only to execute, but to be consistent in their execution. And lastly, of course, we recommend if there's any uncertainties or red flags, it's always best from our standpoint to just pass on that particular opportunity, maybe go back to the drawing board and seeing if there's other strategies that might fit with your organization. And so, one example that we've had with a manager recently was that, again, I mentioned we really believe in doing on-site visits. We really believe in going to the organization, seeing their operations, making sure, again, from a quality control standpoint, it's kind of up to par. We had a manager that we were diligencing. Everything looked really great. Performance was strong. The team was, very capable, very strong backgrounds in terms of some of the organizations they came from, great education and credentials. But we wanted to make sure that this was, everything we were seeing on paper was true to the organization and the underlying investment strategy. So we did an on-site visit, and basically, what we found was that these guys were essentially doing a basement operation. They're essentially operating out of one of their basements, and so this brought up significant concerns, not necessarily on, would they be able to invest, but are there the quality controls in place? Do we have, are we comfortable with the operating aspect? Is there going to be capacity constraints or issues with that type of operation? And ultimately, we want to make sure those risk controls are in place to help alleviate any potential significant risks to our clients.
Stephen, if I could interrupt for a moment, one question came through, and obviously as you think about these on-site visits and a lot being included in the package, what would a standard investment manager fee be? They'll range, but what would you kind of see out there as an average?
Yeah, no, this is a great question. So I'd say I want to split this question into kind of two different parts. So what we see quite a bit, so both passive investing, so passive meaning you're just trying to get what the market's going to provide. And so that would be a very low cost investment strategy that you want to invest like the S&P 500. You could currently do that without any screens or anything for less than 0.5%, 0.05%. Now, when you add additional screens, typically those fees may go up to maybe 0.25%, even for a passively managed strategy. On an active strategy where that particular fund is trying to beat the benchmark like the S&P 500, a kind of standard starting point may be between 0.5% and 1%. And again, we would expect those fees to increase, by potentially, 0.25% or even more, depending on the customization and the type of strategy you may be investing in. So certainly somewhere between kind of, 0.25% to 0.5% potentially in additional fees. Great question, though. Again, fees from a fiduciary standpoint, from an oversight standpoint, are so important because they really do drive a lot of the long-term performance. Thank you for that question.
Yeah.
Another aspect that we really think about and consider is alignment with an organization's mission. And I don't mean this on the investment side. I actually mean this from the parent organization side, right? So is the organization's mission, is your nonprofit's mission aligned with the organization that you're investing with? So not only from a strategy standpoint, where of course we expect those specific screens to come through, we expect from an investment standpoint to be aligned, but is that organization aligned with your mission, or could they potentially be in direct conflict? So we think it's really important to hire managers with their social and moral obligations in mind as well. And we have an example actually recently with a client, a nonprofit organization that has certain goals and objectives and values, and we were investing in a fully custom passive strategy that was really just trying to get broad-based exposure, was screening out all the different organizations, all the different industries that this organization didn't want to invest in. But what we did find when we were just kind of going through the company's website, they highlighted a number of different organizations and causes that they supported financially, that their employees maybe supported either financially or through commitments of time, et cetera. And ultimately, those were in direct conflict with this client's main mission and goals as an organization. So we brought this back to them. We discussed what was happening. We let them know, hey, the portfolio itself is great. We like it. They're fully screened. It's relatively low cost. But however, we did see that they're actually supporting organizations in direct conflict with what you're trying to accomplish. Is that a problem? Should we explore a different alternative? And actually, in this particular case, we went back to them and they came to us and we worked through it. And we ultimately decided, you know what, that's important. We want to have not only alignment of our investments, but we want our mission to be aligned with the companies that we're actually giving our dollars to. And so ultimately, we decided to terminate that manager and find a manager that was fully aligned, not only from an investment screening standpoint and a portfolio standpoint, but also from an organizational alignment. So again, kind of taking that to the next step, if you will. So again, kind of, depending on the organization, depending on the client, there's varying degrees or varying grades of alignment. And for this particular client, this was important. So of course, that's something that we want to take to heart in that particular scenario. The last portion we want to talk about is fiduciary best practices. I know a number of you, of course, have significant responsibilities as fiduciaries, as stewards of your organization's financial assets and financial well-being. And so, talking about fiduciary best practices and the first topic here on board member conflicts, from our standpoint, is incredibly important. So I just wanted to lay out a quick kind of definition, if you will, but a fiduciary whose duty is to serve the best interests of its clients, including an obligation not to subordinate clients' interests to its own. I bring this up because I think this may happen unintentionally more than we realize or more than we want to admit, not out of ill will or out of trying to be deceptive, but just because it's things sometimes we don't think about. So we have a client, as another example, that is kind of a board-run organization. So the board, in this particular case, has a lot of power over what the actual organization is doing, what the employees of the organization are ultimately trying to do. This particular chair of the board worked for an investment company that was fully aligned with the underlying client. But because of his position or her position, is in direct conflict to not benefit from any business relationships, or at least needs to disclose it. So in this case, we had a conversation with the nonprofit, let them know, hey, we do think this could be a potential conflict of interest. We need to have a conversation about it. So we had a conversation with both the organization and this particular board member, and ultimately came to a resolution that said, and they actually agreed. They realized, you know what, we probably should clean this up a little bit. We didn't realize that we needed to disclose this, or that we thought we were doing something illegal, because again, the particular strategy was fully aligned, performance was strong, but ultimately we wanted to make sure that everybody knew, kind of that potential conflict of interest. So in this particular case, again, an advisor that has a material conflict of interest must either eliminate that conflict, or in this case, because it wasn't fully eliminated, fully disclose to the clients any material facts relating to that conflict. That's what we did. We did significant diligence on the board member's organization. We came to a great resolution where we could still have some exposure to this particular investment, but reduce that allocation quite significantly. I'm going to pause. I see another question here, so I want to try to answer that as it pertains to this particular portion of the presentation. So how does a fiduciary fulfill their fiduciary duty by using socially responsible investment strategy if it is later determined that they earned a lower return than if an SRI approach had not been implemented? So great question. We're actually going to talk a little bit about that on the next slide. So I'm going to lead this into that answer. But ultimately, the fiduciary responsibility is truly focused on process, not necessarily outcome. So as long as there is a documented process, so starting again with that investment policy statement, as long as that document fully outlines, the guidelines, any criteria, any screens being put in place, why we're making these decisions, then ultimately that covers a lot of that aspect. Ultimately, it needs to go above and beyond that, of course. So the investment committee or committee who does have this oversight, of course, does need to continue to monitor costs. So specifically to the manager, our costs continuing to be what we consider satisfactory for that particular type of strategy. Monitor performance, of course, and so performance does become a big piece of that. And ultimately, that's one of the decisions that an organization needs to make and need to outline within their process and their policy statement. And ultimately, that's why I mentioned sticking with that through time, because there certainly are periods where socially responsible or environmentally friendly or mission aligned portfolios may underperform. And as long as the process is documented, as long as it's it's applied to the decision making process, then as a fiduciary, that's really kind of what all you need to do. But again, laying it out in plain English so that, again, as there is transitions, as there is board turnover, that there's a consistent process in place is ultimately the most important aspect from a fiduciary standpoint. We also think it's really important to continue monitoring those screens. That's one of the things that, of course, Innovest helps with our clients. So, laying out the screens are important, but let's not only make sure that the particular strategy is abiding by those from the get-go, but let's make sure that over time, as that relationship continues to evolve, that nothing slips through the cracks, that those screens are continuing to be adhered to as stated and as, of course, wanted by the organization. We also believe it's important to evaluate the success of the investment portfolio. So there's a couple of ways to look at that. And I think this is a little bit of a follow-up on that question. Of course, we want to measure performance because ultimately a lot of organizations believe that at the end of the day, the better the investment performance, the better financial shape that we're in, the more that we can do with that money. So that's completely reasonable and what we hear from quite a bit. But there's also a second aspect, and that's evaluating really kind of the social or moral aspect of the portfolio. Have we set out to do what we wanted to accomplish as stated in the investment policy statement by, say, investing more money into certain organizations or certain types of industries that we think are in alignment with us, or having a more of a direct impact Can we quantify that? Making sure, again, from that alignment standpoint, that the portfolio has held up its end of the bargain, if you will, and done what the key stakeholders were ultimately looking to accomplish. So hopefully that answers that question. But again, the most important aspect from a fiduciary standpoint is that focus on process and best practice. And so we're going to dig a little bit more into that here on the next slide. So truly, again, to help answer that question, the law embraces process, which is clearly emphasized in the Uniform Prudent Management of Institutional Funds actions. That's kind of, again, from an institutional investment standpoint, kind of what we're trying to accomplish. So you can see some of the fiduciary practices outlined on the far right-hand side, but this is kind of how Innovest looks at it: listen, analyze, strategize, implement, and monitor. And so when we go through that process, some of the things we've talked about today, it's really that first step: listen, understand what's important to the organization, understand what's important to those key stakeholders, whether it's, again, volunteers, whether it's just important members of the community that are involved in the organization, whether it's, of course, committee members, employees, you name it. Listen, understand what's important to them. So that's kind of the first start of that process. Analyze, so again, focusing on the screens within the investment policy statement: what's important, what's not important. Do we have revenue thresholds for certain industries or sectors? For example, we work with some religious organizations that maybe don't want any affiliation with pornography, et cetera. But is there a revenue threshold? So one example there is that Google is one of the largest companies, of course, in the world, but Google is a search engine. And so there's argument that there could be revenue, even at the very slightest amount, associated with that. Some organizations that we work with say, don't care, zero revenue threshold. A lot of the organizations we work with say, you know what, that's understandable. I don't want to take that big piece or that big piece of the market out of our portfolio, knowing that it makes up such a small portion of the overall company's revenue. So focusing, though, again, on asset allocation and diversification when you talk about these different aspects is so crucial. Strategizing. So this is really, again, discussing how to implement through utilizing maybe an investment consultant, working with investment companies to do the due diligence to make sure they are aligned with your organization, with your goals, with your objectives, and ultimately aligning with your investment dollars. So whether, again, as a foundation or as an endowment asset base. And then ultimately implementing that through actual allocation of dollars. So again, we mentioned the implementation process. So strategizing, then implementing, and then ultimately monitoring, such a key aspect to the ongoing support of a true mission aligned portfolio. So we want to make sure, again, monitoring expenses, monitoring costs, monitoring those experts from a performance standpoint, monitoring those experts from a screening standpoint. We also want to rebalance portfolios, so kind of taking things to the next step. Once we come up with an asset allocation that we think fits for our clients long term, we want to rebalance that portfolio back to those targets on a regular basis, and of course, avoid any conflicts of interest along the way. So again, from a process standpoint, it's really about focusing on that process, documenting it, and making sure you're sticking with that process over time. And so we're going to pause here and do the last polling question of the day. So this is the fourth polling question. So I think some of the answers are going to be interesting here, but what is your biggest concern with potentially exploring a mission-aligned investment portfolio? So is it 1, a lack of knowledge or understanding; 2, increased fees; 3, performance concerns? Of course, I had a question on that. Or 4, something else, of course, that isn't listed here. So what is your biggest concern potentially of exploring a mission-aligned portfolio? Is it a lack of knowledge, increased fees, performance concerns, or something else that we failed to discuss or mention here today? Yeah, this appreciate everybody's participation here. I think performance concerns is generally what we see as the biggest kind of hurdle in moving forward with this type of custom portfolio. So that's consistent with what we see, and we completely understand. I mean, there are some headwinds that need to be considered. I think, we've done a great job, and there's a lot of organizations out there that have done a great job of identifying, really high quality investment managers that can overcome some of these hurdles. So, I think that there are opportunities out there. I think it really involves some expertise in terms of what to look for. But it's certainly, a big headwind long term, and I can completely understand the hesitation for organizations to potentially give up performance long term. That's a big conversation to have with other key stakeholders. So kind of rounding things out, the goal here is to build, of course, a purposeful portfolio. What do we mean by that? But, a mission aligned portfolio, that's what we're talking about here today, of course, with forward construction and objective, high quality due diligence. And so again, focusing on process, not prediction, not trying to predict what's going to happen, but really focusing on coming up with a sound asset allocation based on the organization's goals and their needs, and sticking with that through time, making changes when necessary based on circumstances or any changes at the organization level. We want to be forward-looking in terms of portfolio allocation and risk mitigation. So not looking at the rearview mirror, but how can things evolve? How can things potentially change moving forward? And how could that potentially affect, again, a mission-aligned portfolio? And then, of course, where possible, we want to utilize the lowest cost institutional quality investment products. We mentioned fees, we mentioned costs. Ultimately, the lower the cost, the lower the fees, the better the performance is long term. So kind of summarizing everything, key takeaways, I think that starting question that we mentioned earlier is really a great place to start as an organization when considering mission-aligned investing. But would ownership of investments in a certain company or industry be in direct conflict? I think that's kind of the easiest place to start. And it's a glaring yes, then maybe that's something that says, hey, we don't have to do anything significant, but maybe we should consider at least screening out a particular industry or company. Again, a clear process in mind and policy in place in order to implement this type of strategy long term, and to have long-term conviction in staying power is crucial. Some things to consider. We've talked about them all. These types of strategies typically charge more in fees, which could hurt performance, and so need to be thoroughly vetted by somebody that, again, is an expert in that area. There needs to be an ongoing commitment from the organization or from the investment committee / board to monitor those costs, to monitor performance, and to monitor those screens and processes put in place. And then kind of all this comes about to say, the committee or board or organization, again, needs stamina to stand by these decisions and stand by this process in all markets and over long periods of time, of course, especially during periods of maybe underperformance. So that's kind of the key takeaways. We'll see if there's any questions. I got one slide here that I want to end it on. For any of you that are The Office fans, I'm a big fan, but Dwight here, I think this ends for a nice little funny joke related to coffee, but please don't try this at home. I know a lot of you are at home or in your office. I can't see you, so I don't know what you're doing, but hopefully not trying to drink coffee with your feet. That certainly looks dangerous. So appreciate the time, appreciate you spending your morning with me, and happy to answer any last couple of questions that we may have in the next few minutes.
I think the only other question is actually from me, and I guess that would be, Stephen, what is the risk to organizations if they don't do kind of this analysis and go through this process? What risk and exposure is out there?
Pam, thank you. It's a great question. So I think that's a great way to look at not only what are the risks if we do it, but what are the risks or pushback if we don't. And so, of course, the easy answer is you're going to get potential pushback from significant donors, or if it's a university, significant alumni that may want to contribute money. They may say, you know what, I want to understand what you're investing in. I want to understand where my dollars are going. And so unless we can come up with a plan, maybe I'm not going to provide those donations or that capital that I have historically. I think also there's the aspect of if you are an organization that does have a specific mission, in mind, and you ask that question, if I do invest in this, is this in direct conflict? I think there's some headline risk there in terms of what does that look like if that information is widely known, right? So, if you're a organization focused on cancer and you're investing in all sorts of tobacco stocks, I think that's hard to explain to your key stakeholders, whether it's employees that are working with your organization because they really believe in the cause, whether it's donors, whether it's the community that is ultimately benefiting from that. But ultimately, I think those are some of the key concerns and key risks. So appreciate that question.
Perfect. Thank you.
And then I do see one more, if we have 1 minute, I just wanted to try to touch on this. So giving up long-term returns is not a given. If non-ethical, unresponsible investing is always more profitable, then our future is bleak. So I think this is a great comment. It's not given that you are going to give up long-term returns. And I believe I'm reading this the right way. So maybe I'm not. Giving up long-term returns is not given. I agree. So we don't know. There's a lot of studies that have come out. They're kind of mixed. We see a lot of studies that say there's higher costs associated. So ultimately you're going to have worse performance. We've also seen studies come out that say, of course, just because there's higher fees and there's certain screens in place doesn't mean that you're going to underperform. And so, I think at the end of the day, it's really up to the organization. It's really up to the key stakeholders that are involved in that decision-making process to decide what's in your best interest as an organization, what's going to help you from a grant standpoint, from a fundraising standpoint, from a capital campaign standpoint, ultimately have the biggest impact on your community, because that's why we support nonprofits. That's why they do such important work, and that's why we need significant support in our local communities and of course nationally. So I'm going to leave it there. I think we're right at the top of the hour. I somehow did that pretty well from a timing standpoint. So thank you.
Great. Thank you everybody for joining us today. You should have the link to the slides. Thank you to Invest and Stephen. A lot of insight here, but that's a lot of food for thought to take it back to your organization. So just one last plug. We are kind of doing this investment endowment series. We have 2 more sessions coming up. April 26th, looking at the legal side of things, and then May 25th, looking at the accounting for endowment. So hope you can join us and hope everybody has a great rest of your day. Thank you.